So here are the panelists, Alec Campbell from Rush, Brett Dado from Dado Development of Properties. And I have to ask you, how many national championships in baseball for USC did your grandfather have?
Won 11 national titles.
Okay, 11 national titles, and that's by far and away the highest number in baseball for a coach.
So far.
Okay. And then we have Joe Dick from CBRE, and we have Jane Holman from Willoughby Logan, Jim Hines from Rick Cushman of Wakefield, Randall Kendrick from Zybeck, and Zebeck, and Craig Meyer from JLL. Too used to flying the airline. Okay. So this is what's on your chairs. You can see their Bibles. But what we wanted to do is kind of give you a template to begin looking. If you're really looking for a piece of commercial property or a logistics center, this might be the process that you begin with. And so we created a quick template for a kind of follow. So the first thing you have to do is look at your liquidity. How are you going to get the money to finance whatever you're going to do in real estate? Then you probably want to do some network optimization so you understand how this warehouse is going to fit within your structure in the supply chain. And then you'll see that the focus is on optimizing total cost of your supply chain. Then you would probably look at how you're going to define the requirements of the warehouse. And again, the focus is optimizing total operating costs there. Then you might ask the question, how am I going to operate? Am I going to lease or buy this property? Or am I going to outsource it to a 3PL or some other company like Amazon to do the fulfillment and running of the warehouse? And there's some advantages to disadvantages to each of those. Then you might say, well, do I need a lot of flexibility in the location? And if you say, I only want to be there a year or something, you probably don't want to buy, you want to lease. But the GAAP rules or general accounting practice rules have changed. So today, a long-term lease is treated the same way as buying a building. So then you make the decision, maybe I'm going to buy that building. And then the next question is, do I buy an existing building or do I greenfield it? In other words, start from scratch, bottom up. And then you have to decide how you're going to operate that. Are you going to insource it or outsource it to a third party? So if you insource it, there's some positives, and if you outsource it, there's some positives. But the way we chose this panel to talk today is part of liquidity is crowdfunding. So Jareen and Willoughby Mogul is in the business of finding money to finance this operation. Jeez, I keep pushing the wrong button. Alec Campbell down there has done probably over 100 network optimizations, and that's a lot. But for companies like Estee Lauder, Bristol Myers Squibb, some of those, but he takes where they're manufacturing, where they want to distribute, the customer requirements, and we'll talk about it. But that's what he's doing, is trying to minimize the total operating and physical costs. Then we have commercial sales. We have Jane, Kent, and Craig, who are all real estate commercial brokers. And they do everything from this side forward, and maybe even some things back here. And then we have Randall and Brett, who do these things back here, but their real focus is getting you a property and developing it. And I hope this gives you a kind of a high-level view of how these guys fit within the template of real estate development. And by the way, all these slides, we'll hang them up on the USC site. So today we're going to focus on 8 topics. how do you use network optimization to make your supply chain as efficient and cost-effective as possible? The factors that you need to use to, once you've done an optimization, and it may say the area is Los Angeles, how do you find the right area in Los Angeles? Because it's a huge area. And then some of the factors that are impacting the demand for commercial real estate. Some of the leasing trends that are going on, so it can help you improve and make the best deal possible. Look at opportunity zones, and we'll talk about what those are. Commercial real estate pricing to optimize your cost, occupant trends, and finally, the revolution, and disruption, what to expect in the future. So you'll see our panel, we'll cover these, and the first one we're going to talk about is network optimization, and this is Alec Campbell.
Thanks. I'll just take a couple minutes to go through it. Can everyone hear me? Do I need to get the microphone? One thing we can. So just talking through the concept of network optimization, and Gene was talking about lowering costs, because when you talk about optimization, it's really meant to balance off a number of different factors. You know, you're making trade-offs. The key thing is the business strategy drives the supply chain strategy, which drives your network strategy. So if you have a strategy that is intended to be very responsive to customers, you in theory should probably have your product or inventory positioned a lot closer to those customers, right? Because you want responsiveness. If you're going for a pure low cost, you may decide to have it in one massive facility in a very low cost environment with very low transportation rates on those particular lanes. So it's always a series of trade-offs, and a lot of those trade-offs are things like, you know, what are the real estate costs? What are the market costs that come into play? What's the service level that you want to achieve with your customers? What's the labor rate in a particular market? What's the amount of risk that you want to incur? And by risk, it's really saying, do you want to go into a new market where there isn't any of this, where you don't have a talent pool, you don't have a labor pool, you don't have an infrastructure, you don't have transportation lanes? Those are all things you want to. Different companies have different appetites of risk that they want to take on, and maybe they're willing to trade off a lower cost for more risk. You got, you know, what's your inventory position? Really, you can expand this to saying how do you want to make an investment in assets, both fixed assets as well as working capital in your inventory? What's the transportation rate you're going to pay? How are those rates looking to change in the future? Are they on particular lanes where there's excess capacity today, where carriers are adding more capacity, which might drive down rates? There are a lot of different factors to come into play there. And then obviously there's sustainability and energy, which is a common thing that a lot of companies consider these days. Gene, so I don't make the same mistake as you. Which button do I push? Great, thanks. So clearly, just to, you know, IBM stole a quote from IBM Global Services, which is, you know, the winners, the companies that win, are those that are best able to optimize or make the right trade-offs across all of those supply chain drivers. So you have to consider all of them, consider them within your strategy, and then how do you execute against that. The other quote, a couple of more quotes I want to put in there. An important one is, particularly with the theme of the panel and what we're talking about, but if you're talking about disruption, right, and evolution, the concept is how quickly can you respond to the changes that are there. A lot of these decisions you're making actually fix a lot of your costs on a go-forward basis. So if you think of, and I'll get down, there's another quote later, but if you think of it, if you sign a 7-year lease, or if you build a building and you're tied in, or think of like cold storage, which could be a $50 million, $100 million facility investment, that's a long time investment, you have a long period of time in order to get a return on that investment. So are you able to have a responsive model in that case? You just put down a whole bunch of money, you're kind of fixed in that environment for a long period of time. Then the other thing that's there, because I've done a lot of these optimizations where companies have a preset number of assumptions that go into their model. The quote here is, it also applies to real estate, right? You saw the movie The Big Short, right? The opening quote, which was, from Mark Twain, it's not what you don't know that gets you into trouble, it's what you know for sure that just ain't so. So if you make a certain set of assumptions, so if I assume that transportation costs are always going to be low on this particular lane, and it turns out not to be the case, well, then I'm kind of up the paddle and I'm going to be forced into paying more in transportation than I thought I was going to pay. So it's something to think about when you're thinking about being responsive, and then how do you know you're continually making the right assumptions? The old traditional model of network optimization was, every 5 years, I'm going to spend 6 months, invest a few $100,000, maybe $1 million to come up with a very certain answer. These days, I'd argue you need to be doing network optimizations probably every 6 months. And you got to find a way to do it faster. You may have your set number of facilities that you work on, but a lot of things change around the periphery, and what's happening today might be different than what was happening 6 months ago, 12 months ago, a year and a half ago. So just something to think about. You have to kind of keep evaluating the process. And as I just said, I kind of alluded to before, the challenge with it is once you make a decision on that $50, $100 million facility, you pretty much, and where that is, you've pretty much locked in your cost. I had a client in the food business who moved their plant from Los Angeles to, it was either Utah or Nevada. It was Utah. It was the very southern corner of Utah. One of the challenges they ran into, they built the plant. The plant was on the low, had a lower cost of real estate. However, they couldn't get trucks out back and forth. So their transportation costs went through the roof because there wasn't a market where there was a sufficient supply of vehicles for going back and forth, and you needed reefers to go back and forth. Right? You couldn't just use normal trucks, which makes it even more expensive. It's a one-way trip. So think of it, they made a choice that what they thought was the right choice to lower their cost, but in the end, they did lower the cost. They fixed a certain portion of the cost, but the transportation and the ability to move product became a lot more complicated. And then just quickly, in thinking through this, an example, when doing your network optimization, things to think about include where are your customers, and it's not just where are your customers today, where they're going to be tomorrow. So what's the demand profile look like? Then what's the service level you want in order to satisfy those customers? Do you, again, back to the example, do you want a responsive model, do you want a low cost model, do you want to be within 1 day, 3 days, 5 days, whatever it might be? Then there's the question around where's the supply coming from? Do you have suppliers in Asia? Do you have suppliers in Europe? Do you have domestic suppliers? My company right now is very different from most of the stuff you see today, which is everyone sourcing from overseas. We actually source everything from the industrial Midwest. So everything, all the food we have goes in the opposite direction of those three. We actually benefit because there's lots of open capacity coming in this direction, coming in that direction. Then you want to look at, which is what I just said, what's the transportation, domestic or international, what are the rates, and then how do you minimize the risk overall. So just in a nutshell, trying to wrap it up, essentially network optimization gets you to, the idea is that you can get to the right or an optimal set of locations. Generally, we're going to pick, when you do it, it's going to be logistics centers, because we're looking to minimize risk and give you options to do things and to give you flexibility. So it would be very atypical that we would actually do a network optimization and pick a location in a corner of Utah that didn't have any transportation in and out of it, right? But generally, we're going to get to a certain location. We're going to get to Los Angeles, Louisville, Chicago, Indianapolis, Atlanta, Dallas. We're going to tell you which of these locations are the optimal locations that you should have your facilities in. So hopefully I think I went over 4 minutes, but I try to talk fast.
Well, now I'm going to introduce Jay Dick from CBRE, and he's going to show you how the network optimization set LA, right? So LA is big, and then we're going to show us how that.
Here it is. There it is. We actually practice that. Okay. Hi, I'm Jay Dick with CBRE, and this is a new technology that we've been using in the last 2 years called Dimension. And so you run your network study, and now you said and this goes all over the country, but say you want to be in Southern California. So this is not static. What you see on the screen are the numbers down below. So that's the whole LA basin. And then this is pretty cool. If we wanted to zoom in, now what you're seeing on the screen, now your population went from 16 million to 2 million. That's what's in that block. With all sorts of filters. As when we're talking about labor is a huge driver. So you've got your labor force, you have your household income, but then we can put other filters on here. And I can sit here all day. You've got your drayage. That's obviously a big part. So let me drop in drayage. The dimension is, and then we use, as you see, we give credit on the bottom. A lot of this is Esri and County of Los Angeles. So we have to give credit where it's due. But we take a lot of different information and put it together. Here's a cool one. So this is people that have ordered from Amazon within the last 12 months.
So again, when Alec was talking about, hey, where my customers are, you look at that and you say, do I want to locate 1 million miles from there, or do I want to be closest to my customer?
So this tool alone, I mean, we could do with this for a while. So now I just dropped in drayage. So you said, all right, we're looking at a facility here in the South Bay. Click on that. It gives you your information in Carson. Okay. Maybe not Carson. Let's go out here. What's in the Moreno Valley? There's your different costs, just like that. And then eventually we get to the real estate and we could drop the competitive setting here and you could look at the different costs of the real estate on top of everything. So a lot of information. We're going to move quick today, but it's a pretty cool technology that's helping people in the supply chain.
Jay, how long would it take somebody to do an analysis in the old days without this technology?
I mean, what we can look at on the screen, just with a few clicks of the button, I would think it would take weeks.
Yeah, they would never get through the analysis.
Right. I mean, the amount of information we have here at our fingertips. I mean, you can zoom in. Let me drop the competitive set on here. And let's say, okay, we want to look at a building. So let's look at, let's see if let's go to number 1. All right, so there's number 1. All right, so we're kind of focused on 1 for whatever reason. So let's drill down. That's why I need 2 hands. Now we can look. So you can now see within a few mile radius how many people, what your labor force is, your household spending, and then put other filters on that. I mean, that's really powerful.
That's really powerful.
Yeah, really cool stuff. So anyway, that's just a quick snapshot. This could be a 45-minute presentation on itself, but we just want to give you guys a touch on how technology is helping people make logistic decisions.
Yeah, better.
Yeah.
So everybody, you've seen 2 examples of technology that's enabling better optimization of your supply chain and better operating costs based on what technology can bring. So those were the first 2. Oops, I need to plug this back in. So we covered these first 2 using network optimizations and factors in finding the right commercial real estate location within a boundary that the optimization gave. So now we're going to go talk a little bit about some of the factors the panel think that impact the demand for commercial real estate. And there's a lot of different things going on. Maybe first of all, I'm going to ask Craig because he has some global responsibility for commercial real estate in general. And so what do you think some of those international demand factors are right now?
Well, I run the industrial platform for JLL United States, and I also chair the global board. So I've got responsibility for strategy and logistics and industrial real estate class globally. And I can tell you this, I got three things to talk about. One, this is a global phenomenon. If you didn't realize this is really impacting every major city in the world. We track 21 logistics markets around the world. And I'll throw some numbers out at you. When I went to business school here at SC 30 years ago, you made my fudging there. maybe more than that. 40 years ago, I got my MBA of real estate and finance. And you take a real estate finance course, and you plug in 5% as being the vacancy rate, the full occupancy rate, the full occupancy rate in the space. Today, across the world, the overall vacancy across every major market in the world is 5.2%. The fact that I'd ever think I'd see that in my lifetime is unbelievable. And out of 21 markets, 50% of the markets are below 4%, 50% are below 4%. And there are 4 major markets that are under 2%. You're sitting one right here. The South Bay area, Southern California has been under 2% for over 3 years. So these are really profound things that have happened. So yes, what's really driving this kind of demand? And I'll tell you, it's going to, if you go back about 10 years ago, we all know about Amazon. How many square feet did Amazon occupy 10 years ago? The idea? Take a guess, Mr. Developer.
I'd say probably 20 million feet.
Less. It's about 10 million feet. How many square feet?
Give me my first guess.
How many square feet does Amazon occupy?
That's a small little single.
How much do they occupy in the United States right now?
200.
209 million square feet, 419 buildings. They've been the biggest space dropper ever. Walmart occupies 125 million feet. If you don't think there's a trade war going on between Walmart and Amazon, the American consumer, it's bigger than the one with us with China. You're not reading papers. So, and what's driven that? Last year in 2018, of online sales, all online sales, in the United States, 10% of them were online. You know what they're projected to go to in the next 10 years? 40%. Think about that. Think about the impact if we go and shift into that. What is that all about? It's about how all of us in this room buy our product and what we expect. We used to go to a store and buy product. Now it's getting delivered to your door. We were pretty well satisfied 3 to 4 years ago. We got it 3 to 4 days. If we get it in one day today, you know how much that's forward deploying inventory in most of the city? Do you think about things about like urban logistics? Randy's got a lot of projects across the U.S. where he's trying to satisfy that. To me, this is kind of existential or external to the underlying economy. This has been a fundamental paradigm shift in how we, as human beings, buy products and take them home. And this is universal around the world. This is in Shanghai. This is in London. It's all kind of around that. And what I would say there is even bigger than that is the evolution of people. Now we're talking about business to consumer. The B2B is expecting 3 times as large as that. So this is really driving this demand, driving what all of us are here, why they even have a global supply chain program here at USC, because the thought process around it has become very important. The other thing I'll tell you about that, so you even talk about what Jay showed you right now. We call that the site selection calculus. What's happening today and what you people are doing here is extremely important. All the factors he's looking at goes into every decision. The services that Jay has to offer his customers are nothing like you'd expected when you first started in the business. You go out and find space, you're an expert, and then you look everything about buildings. You know what? That's just table stakes. If he can't do that, no one will work with it. Anyway, lastly, I'll tell you, the amount of capital that's going into industrial real estate, logistics real estate will blow your mind. But just a quick stat. 10 years ago, $20 billion of money was invested into logistics real estate. In 2018, it was $120 billion. All of you know Blackstone. Blackstone is the well regarded, most high profile private equity firm in the world. Well, they're the second largest industrial property in the United States next to Prologis, the largest owner in the world. They own, I don't know exactly, they own close to 400 million feet. Prologis is over 500 million feet. But Ken Kaplan, who runs the global real estate program, a month ago stood up and said, Blackstone is a conviction investor. We believe in certain verticals, if you want to call them that. He said, logistics real estate is a conviction investment of Blackstone, and they went and made the biggest deal in the history of logistics real estate and bought global logistics property for close to $18.9 billion. So that to me is a huge bet. So when I'm, so I'm going to go back again, this is all global, it's happening everywhere we are. By the way, it is a landlord's market, every market in the world. Two, this is a profound change in how we buy things. It's driving it. And third, there are huge, enormous bets being made in this asset class. And so if the takeaway from here is you got to realize what you're doing here in the last couple of days is extremely important. There's a lot of money being spent. We're hearing about a lot of things, and it's going to continue to be a growth business, irrespective of what happens in the here and reading newspapers.
And following the money, following the action. And Raymond, do you have any comments about development that you've seen around these trends and things?
Yeah, I mean, there's been a tremendous change. The evolution of the supply chain started, with the invention of the box in 1966. It started to really take shape in the LA Long Beach Port Complex here in Los Angeles in the mid 80s. And has absolutely, changed and evolved in ways that no one could have ever imagined. But it started with the LA Long Beach Port Complex and the Alameda Corridor, and then the intermodal yards in East Los Angeles. And today, what was a relevant industrial building, or what used to be a relevant industrial building, is no longer a relevant industrial building. And I think that's an important trend that we all need to look at, watch out, or look at. That before we had a very decentralized market. We had, when I got into business in 1986, a big building was a 100,000 square foot building. Now a big building is a 2 million square foot building. And so what's happening is the evolution of the supply chain is making the supply chain more deeply rooted on certain channels, and they're intermodal channels. They're intermodal channels that connect the seaports to the inland ports and the major, population centers. So now you don't need it. Before, if you had 1 million square feet of space in a market, it may have been 20, 50,000 square foot buildings. Now it's one building, and it's near the intermodal yards. And so what we're seeing is whenever you see a technological evolution that essentially rewrites the rules of any economic equation, not just real estate, you have the displacement, you have the winners and the losers. And so what's happening is a lot of the people that owned a lot of the real estate before in smaller tertiary markets, that space is just going to become completely irrelevant. So for the development business, it's great. It's certainly shined on it because we really have to build to core. We have to build new product that these users need today that has the essential elements of connectivity to international intermodal infrastructure and major demographic reach. You have to have both of those things to be relevant today. So it's actually easier to choose. I mean, your guys' stuff is great once you get inside the metro, but we all know what metros we need to be in, to satiate that demand. So.
Okay. All right. So one of the things we've kind of talked about, some of the factors affecting demand, and maybe I could ask Brett to lead off with, what do you see some of the trends in leasing, even though we're doing a lot of development as well?
Yeah, well, I mean, when you build a building, you got to lease it up. And we're also buying existing buildings as well, and lots of with the future lease up plan to reposition the building. Hey, it's the demand, the supply is tight here. Demand's really strong. Here in this marketplace, we're most actively, as we all know, we've got some of the biggest ports in the country, the biggest ports in the country, and then we've got a whole change in that, obviously, consumer buying dynamic and driving growth in e-commerce. So, rental rates have gone up. Rental rates go up. That corresponds really to a rise in land values. So we're seeing land values and pricing that I didn't necessarily think I'd see at this stage in my career. That is driving, and we're talking to some e-commerce companies now because of the price of that land. You're looking at 2-story buildings. We're looking at some of that right now. Something again I thought was going to be further out. Thought it was coming. I didn't think we'd be talking about it right now. I think we are. We're talking about, for instance, doing because all these e-commerce companies are going to focus on that, and they also need delivery trucks that need to get into the residential neighborhoods. So some of those firms we're talking about doing rooftop parking on top of the roofs. Something that we saw in these old buildings in downtown LA and so forth is kind of coming back around again, but land's so expensive that need parking, and then the economics are playing out, but it starts making sense to do it even on the rooftop. So we're looking at that and underwriting and analyzing that now. Things are factored, a lot more automation and things in the buildings drives the need for. And it's a trend that's been going on for a few years, like super flat floors when you're constructing these buildings. So you can put in multi-level mezzanines into a building and other automation features. We're building some more infill buildings that are closer to downtown, not too far from here. Even for mid-sized buildings, we need fairly high ceilings and high clear. Because again, it's hard to find large parcels of land in the more infill, closer to ports or downtown, the population centers. Some buildings that would have been, the same kind of clearance you would have put a 40-foot clear on the building out way, a big building on the New England Empire. We're still putting on mid-sized 50,000 square foot buildings. We're starting to push up the higher ceiling clearance because those customers are more focused on how many pallets they can get and how much storage they can get into in a smaller footprint. So those are some trends I think that we're seeing right now.
Okay. Ken, you want to add anything to what Brett was saying?
Well, to Brett's point, our market hasn't gone to pricing for cube, which is what Brett's referring to. We still price per square foot. So it's a lot cheaper to go up than out, although the construction costs go up exponentially as well. But that is one of the dynamics that I think you're going to start seeing in this market because, when a bunch of us, Jim, when you and I got in the market, what was 24-foot clear, that was a pretty damn tall building. And now, spec is 40, right? So that's come with the advent of factory neutral, ensuring the product with the ESFR, and the advent of a lot better and sophisticated material handling and the use of mezzanines and whatnot. So in concert with the material handling folks and the real estate developer, they've built a better building, and that was all driven by technology.
And I'll add a couple of trends that I think we're also seeing. We've been involved in the cold storage real estate business for a while. There's a lot of us come out that lately. I think the younger consumer is very acclimated to ordering everything online, and now that's starting to translate to food products, groceries, and so forth. So we're seeing more activity in that space. I mean, there's going to be continued growth in the cold storage sector right now. And then I also feel, again, with e-commerce, with just in time, people getting acclimated, getting that product right away, we think there's going to be a lot more of what we kind of call high velocity distribution centers and or transloading type facilities where there's just a lot of doors, a lot of parking for trailers that you need, and it's just moving product in and out. It's not going to be used really for bulk storage. That product's just coming from the ports or from the Midwest, getting broken down, it's getting immediately delivered out to your retail location or consumers' homes. We think there's going to be a continued trend in kind of more high velocity type industrial real estate.
Just to pick up on that a little bit, I'll tell you, we represent Nordstrom's. It's a big retailer, and they've done a big deal out there with Empire. I think they've about 1 million feet. They just did a huge deal last year in Torrance, California, which is an infill location, 500,000 feet. And they paid pretty high rent. I think they would have paid more rent, Randy, because you don't want a believer in the infill and logistics stuff. I think that's a lot of price elasticity. But let me tell you the story on that. So you saw the site plan and the site selection thing. So it's transportation, labor, inventory, and real estate. Real estate is typically 3 to 5% of the cost bucket. And what these other ones can change. So when Nordstrom's came here and took that building, I asked the head of real estate for Nordstrom, like, why'd you pick this building? But we have a flagship store down the 405 freeway in South Coast Plaza. We just built a new flagship store in Torrance, and we have a flagship store in Santa Monica. The new stores are carrying very little inventory in the stores. We're getting it off the storefront. So we are putting up pop-ups. We're trying to create the ability of multiple omni-channel flexibility for people who, if you live in Palos Verdes like I do, and you want to call, you can call down, they'll order it, and they'll be down at the store, they'll bring it to your house, and they'll like it, take it back. But all that inventory is being held in the warehouse. Yeah. And they're pushing through $300 million of inventory in that building a year. So I don't, the site selecting Google would tell you they can pay a lot of rent. You know what I mean? Because that's so much more valuable to them to be closer to the customer. So, and what Brett was talking about, the high throughput, I mean, I think it's for our business, it's super exciting. A lot of opportunity.
Okay, we're halfway through. Does anybody have any questions from the audience that they want to ask the panel?
As well as the transit facilities to cover up to about 70% of the North American market. They want to expand that same day delivery to 90%. Are we starting to see behaviors from companies like Home Depot, Amazon, Walmart in terms of just where they're being deployed, the size, space, and what type of requirements that they need in order to fulfill these strategic initiatives?
All day long. I mean, that's what I'm talking about. Are you kidding me? Gene knows how about that stuff. He's out there. He's killing it out there in the Empire. He's so. I don't know how you got him to come here today.
Yeah, what we've seen, and Home Depot is a great. Home Depot is a great case study because they are rolling out. What happened is we went from small, very decentralized, to really big in more outlying areas like the Inland Empire. That's what grew the Inland Empire and other major metros around. They were outside of the metro. And now you see a big push to get back into the metro, closer to the consumer. And so in the infill last mile buildings, you're a hub and spoke with, incredible demographic reach in just 20 miles. And then there's a tweener, which is kind of a Home Depot thing where they're saying, we'll do a 400,000 square foot building and we'll just be a little bit closer. So there's kind of a tweener that's kind of evolving right now.
Rapid deployment. Those are the ones with 200 truck doors,
right,
on all four sides.
Yeah,
they're just throughput.
It comes in, it goes out.
Right, they're not. So trends. We were talking about the Cube earlier. We've done some deals with these e-commerce companies, and they're not racking. They don't have the time to put it on the rack and retrieve it. So it's all floor stacked in these little cubbies. They put it in. They know where it is. They can go and they get it. You'll be these 600 million square foot buildings, and you can just look from one end to the other with very little rack. Speed.
The thing that, and this comes from CBRE Econometrics, so I don't know if it's right, but they talk, right? Sometimes. But you got to remember in the brick and mortar system of the United States, which will, and Europe, which will never be replicated again in any sort of emerging economy. It is the fact that a tremendous amount of the storage space was in the stores. And today, so for every foot of DC space you need to support a brick and mortar model, today you need 3 feet of fulfillment space. So that's a 3-to-1 multiplier in the industrial sector versus the retail sector. And it's all going to be driven by the smartphones. It's all going to be driven by ever efficient and better delivery systems directly B2C. That's if you're focused on anything else, you shouldn't be.
So we got a 3-to-1 new rule in commercial.
3-to-1 ratio.
How many students are here? Anybody a student in the MS program? Okay. There's a lot of opportunity, I gotta tell you.
You're in a very good space.
If you don't get jazzed about what you're hearing right now, this is really terrific stuff. So a lot of transformational things going on.
I should have gone into that. I graduated with you.
We've got work for you. We don't have enough people.
I don't know where I went wrong. I didn't provide
Good people. I mean,
okay, what we want to do now is go into the area of opportunity zones. And I'm going to have Jay just start, just run the map first. And then we'll have Randy talk about the details.
Yeah, you can go to the map.
Okay.
Yeah, and this is a topic that I tell people I know an awful lot about very little, and that's industrial real estate. But because we happen to have several properties in our portfolio that were in opportunity zones when the tax laws were rewritten, which created the opportunity zone, I'm an expert at this now. So what you need to understand about opportunity zones is they were designed to bring capital into markets and in zones and tracts of land, although I don't think they were always, it was very political the way these maps were drawn. And to encourage development in areas that otherwise wouldn't get those dollars invested, but for the tax advantages that were created by the opportunity zone. And there are two basic areas if you're analyzing an opportunity zone, it has to do with investment in the real estate, which is an opportunity zone fund, or investment in a company that is created in an opportunity zone and operates in an opportunity zone. That's called opportunity zone stock. And so the basic rules of opportunity zone, whether it's stock or whether it's real estate, is if you can today harvest a capital gain, it can be long-term or short-term. So you can have Amazon stock that you have $1 million basis in, it's worth $20 million today, or let's say it's $10 million. You can sell that for $10 million. You can put the original $1 million back in your pocket. You couldn't do that before. You had to pay 10% of the gain. If you invest the other $9 million in an opportunity zone investment, and you self-certify as a taxpayer to the IRS that is a registered, or that is a qualifying opportunity zone investment. So you have to trust the sponsor that they really know what they're doing and that they truly are in an opportunity zone, which you can get the information from the government on these maps to verify that they are there. Then you're in the deal. You have to be in the deal to get full advantage for 10 years, whether it's stock or real estate. And at the end of year 5, you get a 5% step up in basis. So you will never pay tax on that original gain, 5% of it. At the end of year 7, you get an additional 10%. So you will never pay more than 85% of the original gain. And remember, you've taken the original investment and you put it back in your pockets. It's just really beneficial stuff. And if you hold it for the entire 10-year period, you can theoretically, you do not pay tax on any gains associated with that. So that $9 million that we in our original, if that's now worth 18 million or that's worth 19 million, the $10 million that appreciated, you never pay tax on. The other really powerful thing in this legislation that most people aren't aware of, because it's just, no one's tested it yet. The Treasury is telling us, and Kirkland and Ellis is our counsel. They help write the actual legislation, that depreciation will not be recaptured. And that's huge. Not as big in industrial real estate because our improvements are not that much of the overall project cost, especially in the city. But in more improvement intensive types of real estate investments, like a multifamily project, an office building, and especially hotels. Hotels working really exceptionally well for this. You have that advantage that depreciation will never be recaptured. So that non-cash expense you get to shelter the income that's emanating from that investment will not be recaptured. One of the things that most people don't know, and this is a real hook, and so you need to ask the question if you ever invest in an opportunity zone. You don't sell the real estate at the end. You actually have to sell your opportunity zone investment, that unit. So whoever is the sponsor has to have an answer for you as to what am I doing on the backside of this to be able to buy your interest from you at a market value. Because you can't sell the real estate and just distribute it out. You actually have to have a way to sell your stock in order for it to qualify all the way through.
Okay. All right. So that's a great new opportunity that's just coming into play.
It's an amazing opportunity. Yeah, and well, it came into the original 2017, but did not get defined until October 2018, and further defined in April 2019. So yeah, it's relatively new.
All right. Now we're going to kind of move on quickly there. Probably number 7, the occupant trends. Maybe I'll ask Jolene
if she has some comments to make about what she sees happening with occupant trends.
Yeah, sure. I'll sort of blend some comments between where I think it's going in the future and occupancy trends. You know, I run a private equity firm, and we raise the majority of our capital on the internet. So we've had 30,000 people apply to get capital from us to invest in all kinds of real estate. We've invested about $2 billion of real estate since we started the company. And the interesting thing about having all of these applications come in is we see it all, right? In the apartment sector, we see micro units, we see co-living, you know, we see there's a project down in Venice. They put 100 people in 4 townhomes, living in bunk beds, which I've toured, so all kinds of wacky stuff. And we also see a bunch of wacky stuff on the industrial side. And we spent a lot of time on the panel today, I think, talking about infill industrial real estate, sort of last mile, you know, the Amazon effect. And one of the things that I think is really interesting, because I also am pretty involved in the venture capital community, and I invest out of a venture fund. There's a company recently that's raised $300 million of capital. They're called Clutter. I don't know if you've heard of them or not. They're a SoftBank investment. And they're really what's that? They're one of your tenants? Yeah. So they're really a self-storage company. And what they do is, instead of building self-storage facilities in infill markets where you can drive to the self-storage facility and you can store your own stuff and you have your own key to your own pod, they pick it up from your house and then they truck it out to an industrial facility like one of his. And the really fascinating thing there is that what they really are intending to do over the long haul is to use all electronic trucking and have autonomous trucks that are effectively bringing this material or bringing this storage in and out of cities or in and out of where people live. So very, very, very forward thinking, right? You no longer have expensive self-storage. You're using industrial that's out of the infill spaces. And then eventually they believe in autonomous trucking and the ability for that to substantially bring down costs through both electric vehicles and autonomous trucking. So that actually is going to push, I think, demand for industrial outside of the cities. We've talked a lot about, you know, demand inside of the cities. And then there's other new users that I think 5 years ago, we as an industry never really thought of. One of those being the marijuana industry. So we get a lot of requests for financing around marijuana. A lot of industrial facilities are now being built, you know, build to suit specifically for these marijuana companies, for these grow facilities, for CBD, for hemp, for marijuana. So there's a lot of new users that are coming online for industrial, not only, you know, the Amazons of the world. And then there's also a huge impact on retail. And I realize, you know, it's not a retail panel, but I think that there's probably 20 or 30% of the retail in America is overbuilt. And that's really scary to think, you know, 1 in 3 retail centers we really don't need, right, as a society. But you're seeing a lot of conversions of retail now. There's been, you know, just recently 30 big box retail centers that have been redeveloped for industrial use. And those are, you know, tend to be in more infill locations or closer to where people live. So there's a lot of mixed use projects happening. There's a lot of sort of reuse of these big power centers, these big boxes, you know, where the former retail tenants have gone out of business. So I think that's really interesting. And then the last one is cloud kitchens. I'm not sure how many people know what cloud kitchens are, but there's all of these restaurants now that don't actually have a retail location. And you can only order them through Uber Eats or Postmates or DoorDash. And it's a new sort of tenant that's gobbling up what historically would be the retail space or industrial space. So in addition to the Amazon effect, I see all of these new things happening in technology that are going to have an even greater demand for industrial. So I think, to, you know, his earlier point, being a student, you know, involved in sort of the industrial side, like, sky's the limit. It's an incredible place to be investing. You know, we've deployed a couple $100 million in investments in industrial with great operating partners around the country. And we just think that there's going to be a lot more demand for industrial moving forward.
The other interesting use that is crowding out, and it's kind of specific here to Los Angeles, and you talk about, you know, for every action there's an equal opposite reaction, is streaming media. Streaming media, the need for soundstage space in Los Angeles. Soundstage space over the past 4 quarters has been at 96% occupancy in Los Angeles. Rates have gone through the roof. And Apple hasn't really even gotten into business yet. They're just in the process of starting. So we have studio companies coming to us. I don't know if the big article was in the LA Times this week about the opening of the Quixote Studios in Pacoima. That was one of our buildings. And it was just an industrial building. They came to us and said, stop, let's take columns out so we can build our sound stages inside. and they invested like $5 million in the building. And it was, so we're starting to see, even the really great infill locations that you thought for sure was the infill last mile. And then a studio comes and says, hey, you're inside the TMZ here. You're inside the 30-mile zone. Stop. We
can pay more.
Yeah, we can pay more, and we'll sign a long-term lease.
Right.
Yeah, no, it's amazing. So.
Okay, we're going to get to the last question here. How do you guys see commercial real estate? Evolution, revolution, or just disruption, or a combination of things all going on at the same time? Maybe we'll start with Brent and just come on down the line.
Yeah, I think for a lot of us, you're so close to it, it seems like an evolution. But I mean, as you kind of got here and I thought kind of more about it, I think for you really kind of take a step back. And I think really it is more of a closer to a disruption than an evolution. So I mean, I think just kind of the industrial market, as I think a lot of us once knew it, has really changed quite a bit. And so I think we're thinking about it differently, approaching it differently, and it's definitely become a more fast-paced, innovative sector than it used to be. And so it's an exciting time as well, said to be in the business. And I think it's disruption creates opportunities, and I think that's what a lot of us here are excited about, the opportunities that are creating for our respective careers.
Yeah, I was going to actually, you stole one of my words, pace of change. It seems to be accelerating, right? Whereas you had much longer, more static periods to make decisions in. It seems a lot more dynamic and a lot more factors. I know, when I was doing a lot more network optimizations, we used to pitch to that you should do this more frequently, because the old model was once every 5 years, if they even did it at all. Now we're seeing it, you got to do things, you have to do analysis a lot more quickly. A lot of my colleagues that are still in the logistics world, the number and the variety of supply chains and the customizations for those supply chains are increasing. So that's I don't think it's going to stop.
Again, when some of us got into the business, there were a number of operators across the board, and now you've got 4 or 5. You've got Blackstone, Goodman, Prologis. So you've got these enormous companies with incredibly large scale that will be able to kind of think ahead of what their customers going to do. I know the folks at Prologis and these other guys are spending a lot of time, which was never before. It used to be, hey, there's 5 acres, I'm going to throw up 100,000 feet, and we're going to put it up to the market, and we blow and go. And the real estate operators of today are employing a lot of technologies, really digging into those algorithms to understand what they're going to look like.
Mm-hmm.
Okay. Craig?
Pretty clear. I'm a conviction investor. I have a lot of belief in this, and I'll tell you that, and it ranges from the complexity of today in helping companies find locations, but site selection calculus, if you will, all the way getting really granular. What Galena was talking about is uses today that we didn't anticipate in locations we didn't anticipate. I can tell you our company's involved in 5 multiple-story buildings in the boroughs of New York. Every one of those sites were scheduled to be multifamily, and the dynamics changed around that. To me, it's intriguing. It's interesting. I think there's huge opportunity over a long period of time.
I think the future is all about speed and optimization. On the speed front, it's cultural. I mean, I grew up in a younger demographic where we had a cell phone in our pockets. I got my first cell phone when I was 12 years old, and we now expect that we can order anything on our cell phone and it shows up in 15 minutes or half an hour. So I think that's going to change industrial real estate, just real estate in general, a lot. And then the other one is automation. I spent a decent amount of time in Japan. We've got some investors in Japan, and my last trip out there, we were touring a robotics facility. And they have an entire sort of industrial facility where there are robots that are doing tasks that you would think like screwing in screws, where like huge dexterity, right? That never would have been something we would have imagined a robot could do. So I think we're going to end up having major factories with robots. The robots, load the trucks are driven autonomously and, into the cities. And I think that's coming in our lifetime. So I think speed and automation is a huge piece of it, and figuring out, how do you build real estate around that? Sort of the old Wayne Gretzky quote, skate to where the puck is going. And I think that's where there's going to be just a tremendous amount of money to be made in real estate.
Yeah, I agree with everything. I was looking on my phone because I was trying to find a Wall Street Journal article on a remarkably interesting new startup called Adabotics. It's a Canadian company, and they're working to shrink the size of the footprint of warehouses. So this could be a little bit like, Craig, you remember back in the 80s when everyone wanted fiber optics until they found out how to put 10 times more through the fiber line, and all of a sudden everyone had too much. So being a contrarian, you could have some technological innovations within the warehouse space that it does get so automated and robotic that we need less square footage. But for now, I think, the sky's the limit with industrial real estate. I think a lot of time and energy, I spent a lot of time thinking about how to better automate the truck court and how to improve the throughput, especially our urban locations. We're working on some innovative designs to be able to, increase the speed at which a truck can access truck court, park its deal, get out of the truck court, have an automated yard mule pick that can up when it's empty and put it on the other side of the yard. And we'll be able to do that all with innovations in the next few years. And so those sorts of things, where before it took, 100 trucks, 3 days, it could be 100 trucks in a few hours. And so those technologies along with the equipment, evolution of the equipment to be able to utilize that technology like GPS is really going to change the game.
Yep, I'm gonna go last. I agree with everything that's been said so far. Ditto. I think we're gonna see all three: evolution, revolution, and disruption. Technology is gonna play a big part. Automation is gonna play a big part. We talk about what's gonna happen when people aren't driving, and you're gonna have all this extra land that you don't need parking lots anymore, and how to repurpose those. So it's exciting times, and in our world of industrial real estate, I see, we're lucky in the Inland Empire, an old building is 20 years old, so we're not quite like the infield product, but people did max out the coverage, and now I'm seeing so many requirements that we're looking at tearing down apart of a building that would have been built 50% coverage. Well, now maybe they only want 30%. And they'll pay
because you need that throughput.
The throughput, like exactly what you're talking about on both the yard and the efficiencies. So.
Okay. Are there any questions from the audience for the panel? Okay.
What I observed there was always when it comes to retail model, obviously it's always been a type of system. Every big box store, the anchor, and then the other side of it, it seems like at this point there's a back trend, for the United States as well. There is the same type of system as well, where that's into, like Tokyo and then actually have to probably realize that space much more efficiently. Do you think, and this is project, you guys also see that there's a correlation there, saying, well, we'll also move in the same direction of population, right? I could say there, go off these fast, so how do we get in our space and then with the water, how we make it, how we talk about it.
So we do look at this a lot globally. We have an urban logistics practice. I can tell you, so in Tokyo, Hong Kong, there's 130,000 people per square kilometer. New York City, there's 11,000 people per square kilometer. And that's the most dense city we have in the United States. You begin to see that. In between are places like Mexico City and certain areas and things like that. Why is urban logistics kind of growing as the density is there? It's all about a mixed use thing. So we're involved in a project in London, which is residential on the top, retail here, and then they have a subterranean warehouse distribution for product for the neighborhood. So that's the beginning of that. Some of the projects we're seeing being designed in New York will have a ground floor, like an Amazon store, with quasi retail on that. And I do believe when you were talking about the food thing. Yeah, that's really, we think there's a lot of growth in that too. So I think a lot of what kind of went around is coming around again, but it's a lot about density and it's all about time too. When you talked about speed and automation, we look at the cities and we're valuing time as a function of rent too. You know, so there's a reason. I'll give you another stat. Outside of New York, there's exit 8A, which is the big docks area coming all the way into the Meadowlands, and the Meadowlands you hop over the Hudson River into New York. 5 years ago, that was 12% vacant. Today, it's like 1% vacant. And so you have a reason for that. It's all condensing down. It's all, you know, it's because you can't get in and out of New York. Right. So they got to forward deploy. And then who asked a question about retail rents? The other thing was we're running a model today that compares rents in an industrial building and an infill building versus what the rents are in a retail. Yeah. So what we're beginning to say is these infill buildings are just cheap retail. Yeah. You know, that's another word for it. So
yeah, and I think,
question.
and I think you're exactly right. More people want to live in smaller, you know, the population just keeps growing, and that's just demographics. And necessity is the mother of invention. And so I think using spaces more effectively and more vertically is just part of that process of invention, because there's just a necessity for it. Just like there's a necessity for better traffic, you know, traffic light systems to handle the traffic, and then that'll kind of go away when we have electric cars. So then you're thinking about, like, we're looking at building parking garages right now. We will build them flat plate, even though it's more expensive and less efficient, because I think in 10 years we're going to have to convert that. And I'd rather have a flat plate than a sloped floor in a parking garage. So, and then you start thinking about the heliports that are going to be the taxis, the drone taxis that deliver people around the LA basin. So you start thinking, okay, well, I should have a drone delivery port capability up high in my building. And I may, on top of my parking garage, I may want to, you know, find out what the specs are and make this a node that those things can land at, because they're not doing it now, but they will land there, you know, within 10 years for sure. You know, so the only constant is change, and it is just really accelerating right now in the logistics space. But the great thing for me as an entrepreneur, and I've been doing this for 33 years, is before the real estate people didn't talk to the logistics people, and logistics people didn't talk to real estate people. You know, we just did our deal, and we said there's a 120-foot truck court, live with it, and you got 24-foot clear. You know, that's how we use it, and we never talked. Now we are talking, and the reason I got involved with this, with Nick and this program, was I'm that excited about the fact that finally we can talk to logistics people, and logistics people can talk to us, and we can start developing the same language. We can start understanding each other. And because, you know, we're very creative people, as they are. And so, you know, let's all think about this problem together, because we you know, we have to look at it that way in order to get the right solution, especially in dense urban locations.
Okay, well, I want to thank the panel, Jay, Randy, Jeremy, Craig, Kent, Alec, and Brett, because I know you guys are all highly successful, and every minute you're spending here, you're not making money. So, but we're proud to have most of you as Trojans, and I know this is important to give back because we're all a Trojan family. So you can see it in action here. But to summarize a little bit real quickly, you guys saw a network optimization and how that helps to figure out lowering your overall structural cost of your supply chain. 80% of your cost is going to be in the way you design your supply chain. Secondly, you saw from Jay some of the things and tools, technology tools that weren't possible 5 years ago even, where you can run all kinds of analytics that enable you to make even a smarter decision, so you can lower your operating costs once you know your structure. And then we heard a bunch of factors from Craig around the international trends and some of the things that are happening there, and leasing trends from Brett and from Kent, around everything from multi-story warehouses to parking lots on top, crazy things that you never thought were going to happen. And then we heard from Randy about opportunity zones, and we kind of skipped that commercial real estate pricing, although that's probably the biggest thing everybody was concerned about. I didn't even think about that way. But some of the occupant trends, everything from kitchens to some of the things that the retail space is driving, the 3-to-1 rule. I got to remember that 3 square feet of background or I guess infrastructure to support the 1 foot of square foot of retail. And then we talked about evolution, revolution, and disruption. And I think the key thing is the supply chain and the clients are demanding different things. And the commercial real estate is being affected and impacted directly by what the clients or customers are demanding in the marketplace. And you're hearing these guys are all successful. They have got all these creative ideas. And I mean, I heard Randy talk about it keeps him up at night or he's worried about all these things. The reason that they're successful is because they're trying to figure out a rational and being able to monetize decisions that play into what's happening in the supply chain. And so this innovation in this area is going to be tremendous in the future. So again, thank you very much, and I hope you guys enjoyed it.